So in the current estimates, the government thinks that for every pound it lends, it expects to get the equivalent of about 75, 77 pence back. So on the official government figures, it's subsidising every loan by about 23%. 23p in the pound, 25p in the pound doesn't come back. So that's where there's still some public subsidy. And a large part of that subsidy is subsidising low earners. At this point, we need to say something quite fundamental about the loans, which is that loans are inherently uncertain. With grant spending, the money's gone out the door and you know it's gone out the door, so you know where you are in terms of the accounting. With loans, the money goes out the door, it goes off into the world, and over the next 35 years, repayments come back. I've already cited these figures that the government expects to get back the equivalent of 75p in the pound it lends. But it's going to get that back from loans it makes today, from people projected future salary paths of millions of graduates up until 2050 or something like that. So the government is forced to look a long way into the future, and it's forced to make a whole load of assumptions about the state of the British economy for the next 40 years, what's inflation going to be, how are average earnings going to behave, et cetera, et cetera. And it's also got to make a load of assumptions about what individuals' salary paths are going to look like. What are people going to be earning? How are individuals going to vary? So it's saying this policy's sending 20 billion out in the world, and we think we're going to get back 3/4 of that, so we're going to get back 15 billion, or the equivalent of 15 billion in today's money over the next 35 years. So it's that uncertainty, which, if you like, is the Achilles heel to some extent of the loan policy. But for a particular department, now it's a Department for Education has the student loans on its accounts, it's been given a certain amount of money to cover the estimated loss on student loans. If those projections start changing, something go, oh no, it's not 25p now, it's 30p, they have to find that resource from elsewhere. They've either got to go to the Treasury and ask for more resource, or they've got to take it out of other budgets. So the kind of political pressures on student loans are more indirect than we might be used to, and they are more related to things like projections of how much loan's going to come back. We've already seen this problem with student loans. In 2013-14, they realised they'd done the modelling wrong. Their estimates of non-repayment diverged from the budget, and they had to do a number of things in order to deal with an immediate budget crisis that they were expecting to get 70p in the pound back. Turns out it was looking like they were going to get 50p in the pound back. Something had to be done. And the way the Treasury did it in the end was it realised it had too much of a political problem to sort of pull the plug on the loan scheme just as it was getting going. So it changed the accounting on student loans, and it enabled it to defer some of the problem into future years and future budgets of the department. So we've already lived through one of these budgetary crises, and it was resolved in a number of ways, most of which look like accounting fudges to people. So the government's kept this ability to manage the loans in a sense of, unlike commercial loans, the government has the ability to vary the terms and conditions on the loans. So, the loan's got a repayment threshold, it's got a repayment rate above the threshold, it's got an interest rate, and it's got a policy write-off. All of those are administrative details which are in the hands of the executive, the government of the day, to vary. And that's not just for new borrowers, it's for people who've already taken out the loans. So anyone who's taken out a student loan has effectively signed a clause saying, I agree to repay my loans in accordance with whatever terms are in effect at the time of repayment. Future governments may vary the terms of student loans. And this is, perhaps the most problematic aspect of student loans. In order to deal with the uncertainty, and this was the kind of what I was saying a few minutes back, is that, the problem with loan is the uncertainty. In order to deal with the uncertainty, the government has to give itself, or has decided it has to give itself, powers to manage that uncertainty in ways which you wouldn't see with commercial debt. No commercial provider would be allowed to kind of retrospectively change the terms on any debt you'd previously acquired. Credit card companies write to you and say, we're going to change the terms of interest, but it's not meant to be, retrospectively applied to debt you've already taken on. and there are complicated ways credit cards work out which debts your repayments are actually paying off because of the timings of when the interest effects kick in. So this makes the politics of it all very different. So this is the sort of first question is, the long-term sustainability. This would lead us in to this question of the sale of student loans. And the government has a number of aims and objectives with the sale of student loans. The key ones are it wants to de-risk the balance sheet. What that means is it wants to take that uncertainty, that risk of varying repayments off the government balance sheet, and it would like the private sector to take that risk. The other thing is it would like to convert the student loan asset into cash, because although the government holds the asset, the student loan is a debt that is owed to government, it's considered to be an illiquid asset. It's very difficult to sell. And so when we look at headline statistics like public sector net debt, the government's asset here, the student loan, isn't netted against debt in that figure. So at the moment, student loans as an asset are missing from national debt as a positive thing for government. We are owed £75 billion. That's a plus score. We take that off the debt. For all the things we've said around the uncertainty of student loans, why would I buy what you're trying to sell? If it's too risky for the government, how is it not a big risk for a private company? The only way it will get a company to take on those higher level risks is if it's offered at a discount. And that's really where the attention should be focused. The government tells you how much the loans are worth in its accounts, and it will sell them for less than it thinks they're worth in order to manage these two other outcomes, the risk and debt. So whoever holds this bit of paper can come to me in 10 years' time and say, you owe me £100. That's a face value of £100.
Yeah.
Okay. Would you give me £100 today?
I don't think so.
And quite right too, but for a number of reasons. There's all manner of risks inherent in this. Also, what's the value of £100 in 10 years' time compared to £100 today? Inflation will erode that value. You also may have £100 in your bank account, but you're saving up to buy something else. Or you have another friend who's trying to sell you a piece of paper with £100 IOU written on it, and you know that he will accept a lower price than me. You've got an alternative investment.
Sure.
So all these things get factored into this question. This has got a face value of £100. I know more about my ability to repay this than you do. I might have very different assumptions about alternative investments, or how difficult I think it's going to be for me to meet this demand in 10 years' time. I may think the economy is going to move differently. We may have different beliefs about inflation and interest rates and all sorts of things. So the way you value it and the way I value it, I'm going to be evaluating it as a liability. I'm going to have to meet this cash demand in 10 years' time. For you, it will be a promise to pay in 10 years' time. We're both going to put a value on it, but you will be evaluating it as an asset. I'll be evaluating it as a liability. It's the same bit of paper. It's the same promise. So for a number of reasons, we will have different fair valuations. But the face value and the fair value are not the same thing, and the price is a different thing again. The price is what we agree for the transaction, and we need to keep those three things conceptually separate. The important thing about the fair value, although I've said, okay, we're going to have different fair values, and this is an important point we might come back to, the government in its accounts tells the world what the fair value of the student loans is. It tells the world, this is what we think these loans are worth. Mm-hmm. So in the student loan case, the face value is that balance that says you owe the government £40,000 in student loans. That's the balance that's going up every year, because of inflation, and maybe inflation is accruing faster than your mandatory repayments are eroding the debt, which many people will experience, and that will be an unfamiliar debt experience, to be making the minimum repayments, but the balance still to be going up. That's the face value. And when we say the face value of student loans is £76 billion, what we're doing is totting up all those balance sheets, all those balances that say, you owe the government £40,000, you owe the government £27,000, you add them all up together and you get the £76 billion. Now the government knows that that £45,000 or £40,000 that it says you owe them is not going to translate into £40,000 in repayments. And it certainly knows that the £76 billion of face value isn't going to translate into the equivalent of £76 billion in repayments in today's money. So it has to come up with a fair value estimate of what the repayments are worth.
Yeah.
And that fair value estimate, I should have brought the figures along, somewhere in the region of 50 billion, I think. So the loans, English loans have a face value of 76 billion, they have a fair value of something like 50 billion, but the 50 billion is what the government says they're worth. When the third party comes along and tries to buy the loans and it says, well, I'll take those loans off your hands, and the government says, okay, let's say 35 billion, that's the price, the government's made a loss there. But the loss isn't the difference between 35 and 75, which would be 40 billion. It's the difference between 50 billion and 35 billion. So the loss would be the difference between the fair value and the price, not the difference between the face value and the price. And almost any sale of student loans, they will be sold for much less than the face value, because we know the fair value of the loans cannot match the face value of the loans. But what matters when they're testing whether a good price has been achieved is what's the relationship between the fair value and the price.